Well, the chaos in the Chinese market continues. Remember, the market with its 8% cut witnessed the biggest fall since 2007. That made investors very nervous. Now, this problem in China is very local in nature. The Chinese market is exposed only to the tune of 2% to foreign investors. Most of the money sloshing around is retail money, leverage money, margin-funded positions, which on a cumulative basis stand at a whopping 7.5 trillion yuan, which essentially means almost 3x of the cash positions taken. That's the kind of liquidity that's sloshing around in that market, which the authorities are trying to clamp down on, and which is why, we witness this big drop. There is a sense in the market that the authorities would come heavy in terms of reducing these positions, and they would start off with perhaps curbing, the positions on blue chip counters or blue chip stocks. So that was really the trigger point for the sell-off today, which led to the Chinese market falling. So it's a more local problem than global, but the implication for the rest of the region was from the Bank of America Merrill Lynch survey, where the report indicated that nearly 75% of the investors believe that China is overstating its GDP. The actual GDP of China stands at below 6%, not 7%, which is being projected by the authorities, but actually below 6%. And investors are also worried about high debt levels, low rates of interest, creating a sort of a market bubble, which can trigger a panic sell-off when the bubble actually reaches its tipping point. So these factors added to the confusion, and which is why what seemed like a local problem in China actually spilled over into a sell-off for the rest of the region as well.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.